You've probably heard people say that the Fed is lowering interest rates. Recently, the Fed lowered the interest rate to approximately 0%, which it hasn't done since the Great Recession. It's not unusual for the federal government to lower interest rates during times of economic uncertainty. But what does that actually mean, and how does it affect you? The interest rate you hear about is for Federal Reserve funds, which are short overnight loans that banks will use to lend to each other. So, why are banks lending each other money? By law, banks have to meet the reserve requirement, which means they must have a certain percentage of their customers' money on hand. Banks will borrow money from each other to meet the Federal Reserve requirement. The federal interest rate is the rate that banks charge each other for these loans. So, how does this bank-to-bank lending affect you? The federal interest rate is considered a base interest rate, and many banks will use it to determine interest rates for consumers. For example, many people have variable credit card interest rates that change based on the federal interest rate. With the latest drop, most Americans could see their credit card interest rates drop by about 1%. That might not seem like a lot, but the average American credit card debt is $9,300. If the annual percentage rate drops from 19% to 18%, consumers could pay off that debt in 55 months instead of 57 months. So, if the minimum monthly payment is $250, they'd save approximately $442 in interest payments. Overall, this is good for people with credit card debt, but it's not all good news. High-yield savings accounts have become popular in the past few years. If you have one, you might have noticed that the yields aren't quite as high anymore. That's because these banks tend to tie their interest payouts to the Fed's interest rates. When the Fed's interest rates were higher, these banks had higher yields. Now that it's effectively zero, most banks have lowered their interest payouts. The good news is that since banks aren't paying as much money to lend to each other, they tend to lower their lending rates to consumers and businesses. This means the interest rates on personal and business loans are lower. There are pros and cons to lower interest rates. You may earn less on your savings, but you might also pay less on your debts.